Tonight here, the images that say it all. American families looking for any place they can to save even a little on gas.
Americans bumper to bumper. These long lines outside a Costco in Monterey Park, California, where the average price for a gallon of gas is now $5.73.
I don't even want to know right now. I don't even look.
And gas prices up another 7 cents in just the last 24 hours.
A gallon of milk up 50 cents, a dozen eggs up 40 cents, and bacon spiking more than $1.30 over the last year.
In the US, food costs 7.9% more than last year. Energy, 25.6%. Specifically gas, 38% more. US inflation is at its highest since 1982. That's 40 years. But how? And why? And what's next? In order to make sense of this, we'll first quickly cover what inflation is, why a bit of inflation is good, why too much of it is bad, why US inflation is rising, what US will do about it, and finally, we'll discuss how it'll affect you. Oh, it's a lot to cover. Everything is timestamped in the description box, so feel free to hop around and let's dive in. Let's say you have $100 and a certain basket of goods costs $10. You can buy 10 baskets with your money. When inflation is at 10%, that shows the same basket now costs $11. So now you can only afford 9 baskets with the same amount of money. Inflation is a loss of purchasing power of a given currency over time. It is typically expressed as a yearly change in prices for a basket of goods and services. In the US, there are 2 main types of inflation indexes. One, the Consumer Price Index, or CPI, and the other, the Personal Consumption Expenditures Index, or PCE. Both indexes calculate the price level by pricing a basket of goods, but the baskets aren't the same. The CPI is based on a survey of what households are buying, the out-of-the-pocket expenditures. The PCE, on the other hand, is based on surveys of what businesses are selling, including medical care. The CPI reached 7.9% in February this year, compared to the same time last year, its highest level since February 1982. That's 40 years. That was CPI, the value you see all over the news. But the Federal Reserve, or the Fed, or the US Central Bank, who is in charge of controlling inflation, states their goal for inflation in terms of the PCE index. The February numbers aren't here yet, but the PCE2 rose 6.1% in January, compared to a year earlier, and the index that excludes food and energy items, that is the core inflation, was up 5.2%, the highest readings for both measures in 40 years. The Fed thinks that inflation of 2% is most consistent with their maximum employment and price stability goals. But why? Low inflation, inflation that is below Fed's target of 2%, means demand for goods and services is lower than it should be, and this tends to slow economic growth and decrease wages. A moderate amount of inflation is generally considered to be a sign of a healthy economy. As the economy grows, people demand more stuff. This demand increase pushes the prices a little higher. Suppliers try to produce more of the things people demand. More demand means more demand for labor, which is good for employees. Wages go up. Finally, better paid employees buy more stuff, and the cycle continues. Of course, inflation doesn't cause this chain reaction. It just is an indication that the economy is growing at a healthy pace. Inflation also makes it easier to borrow money. As money gets less valuable over time, it becomes attractive to borrow money and repay loans with money that is less valuable than the money borrowed. This creates a lively borrowing and lending environment, which again increases spending on all levels. On the opposite end, there's deflation. Deflation is an indication that prices are going down. This is particularly bad. When prices are dropping, people hold on to their money. Who wants to buy a car now if they know they can buy it for less in a few months? This is called the paradox of thrift, coined by the British economist Keynes. Demand goes down, businesses suffer, so do the wages and employment rates, as we saw between 2007 and 2009 during the Great Recession. But too much inflation is just as bad. High inflation means your money can afford less as the time goes by. This pushes people to buy now than later. Individuals tend to stock up on gas and food, and companies make capital investments such as buying gold, although buying stocks seems to create the best hedge against high inflation. Unfortunately, more spending and investing gives the market more cash no one particularly wants. The supply of money goes over its demand, bringing down the purchasing power even more. This pushes central banks to increase cost of borrowing. When interests go up, collecting interest becomes more attractive to people than spending money. As a fine-tuning move, the central banks can also sell bonds to clear off as much money from the market as possible. Alright, back to January 2022. Inflation is at its 40-year peak. What went wrong? Back in February 2021, so exactly 1 year ago, CPI was just 1.7%, 2.6 in March, 4.2 in April, 4.9 in May, 5.3 in June, by October, 6.2, by November, 6.8. You get the picture. At first, Fed Chair Jerome Powell thought this was a transitionary problem. What do I mean? Oh, come on in, COVID. The stage is yours again. When the pandemic took over the world in early 2020, people went into lockdowns, businesses closed, 22 million Americans lost their jobs. Companies stopped investing, restocking was paused. But the government intervened. Joe Biden's $1.9 trillion coronavirus relief package delivered $1,400 checks to most households. The Fed brought interest rates down to almost zero, and this spring, the economy displayed an unexpected recovery. Thanks to the vaccines, people returned to restaurants, shops, and airports. Businesses had a hard time meeting this sudden demand. They couldn't hire fast enough. Wages went up. This was perhaps the best time to find employment in a long time. Companies couldn't buy enough supplies fast enough. Ports couldn't handle the sudden increase in traffic. Shippings got delayed. Global supply chain got clogged. Guess what happened next? Costs increased, and companies realized they could pass the increase in costs to customers by updating their price tags. Many people had managed to save a lot during the pandemic anyway. Critics blamed Joe Biden's $1,400 checks for overheating the economy. Well, it became clear to Fed that the inflation won't take care of itself as the pandemic eases out. What's left for the Fed to do is increase the interest rates. But this is not as simple as it sounds. Increasing interest rates could actually lead to a recession, like it did back in 2018. How? The cost of borrowing goes up for consumers and businesses. It costs more to buy a home or finance a company. In turn, people spend less, and the economy slows down. Stock markets go down. This also stabilizes the cost of goods, and inflation is hopefully taken under control. The next Fed meeting is going to be held on March 15 and 16. That is only a few days after I publish this video. The Fed is expected to raise interest rates by 0.25% at this meeting. It will be the first rate hike since 2018 and is predicted to be followed by at least 6 other hikes this year. Rising prices were first observed in autos, electronics, furniture, and other household goods that were directly affected by the pandemic. But it's now spreading into broader categories of spending, especially rental costs. Although employment rate in the US is going up, it's still lower than pre-pandemic. And while wages are going up, they are growing at a lower rate than prices overall. So the average employee has lower purchasing power. The hiking of interest rates will take pressure off the prices, but it will come with other consequences. Here's how Fed's response to inflation might affect you. 1. Loans. Higher interest rates mean costlier financing for borrowers. This includes mortgages, student loans, auto loans, credit cards, margin loans on investment accounts, and other types of debt. 2. Investments. If you have money on stocks or have plans to invest in stocks, be careful with growth stocks, namely high-growth companies. High-growth companies borrow at a low rate and fund innovative projects with it, delivering returns over market average. Increasing of interest rates might affect the performance of these stocks negatively, as these companies will no longer borrow cheap. Investors might allocate more money to value stocks, stocks that trade at a lower price relative to their intrinsic value at this time. If you want to learn more about the difference between growth and value stocks, let me know in the comments down below and I'll make a video about it. Finally, employment and wages. Lower demand may impact jobs and salaries. Post-pandemic, we witnessed a sharp spike in job openings. This might no longer be the case after the interest rate hikes. Regardless of the interventions, inflation is expected to normalize by the end of 2022. But this knowledge alone won't change the fact that struggling individuals and families and companies will keep struggling in the short term. The Fed has a tough job. Stabilize the prices, but make sure that its interventions doesn't lead to a recession like it did back in 2018. We'll see in the coming days what the moves of the Fed will lead to, but its consequences won't be visible for another couple of months. In the meantime, the war in Ukraine keeps putting pressure on commodity prices, challenging the world economy in its own ways, US being no exception to this. The Fed has declared to be taking cautious steps in the light of the current events in the world. What's left for us is to wait and see. Thanks so much for watching this part. If you're interested in money and how it has affected societies over the past few hundred years, you might enjoy my video up here. Like and subscribe if you can, and I'll see you next time. Bye!